In today's video, we're going to talk about how the money you make from investing is taxed. Hey wealth builders, and welcome back to another episode of The Bemuse. If you're new around here, my name is Akiva, and on this channel we talk about all things money for young adults just like me. So if you're into that, I hope that you come join the squad by hitting that subscribe button and turning on that notification bell while you're at it so that you never miss when we post new videos. So this video is our fourth video in our investing series. So if you're new to investing and you want to learn more about how to get started, I suggest you go back from the beginning. I'll make sure I put a card up here so that you can go and watch this series from the beginning. So far, we've covered what investing is. We've covered some crucial definitions that you need to know before making the plunge into investing. And in our last video, we talked about several popular investment vehicles like stocks, ETFs, mutual funds, talking about the differences between them and how they work. So now that we've got that covered, we're going to talk about how the money that you make from investing is taxed. So big disclosure, in this video we are focusing on investments that are held outside of like a retirement account or any other tax deferred type of account. We're just focusing on investments that are owned in your traditional taxable brokerage accounts. That's super important. Now to set the stage for this video, I've got 4 more definitions for you guys. The first of which is ordinary income. Now, ordinary income is any income that the government will tax at your regular ordinary tax rate. And by the way, if you want to learn more about how taxes work and how these tax rates work, we actually have a series on taxes, completely devoted to taxes that we did back in the beginning of this year. So I'll also put a card up here if you want to go check that out as well, in case you want to learn more about how taxes work as well, because I think that'll help you understand this video a whole lot more. Second is a capital gain. A capital gain occurs when you sell certain investments for more than what you paid for them or your basis. Now this income is taxed at a preferential rate. It's not taxed as highly as ordinary income. And I'll put a graph on the screen right now to show you the difference between your ordinary income tax rate and your capital gains tax rate. Now, when you have a capital gains situation, when you sell an investment for more than what you paid for it, you have also created a recognized gain. And in most cases, you'll pay that capital gains rate, that preferential lower rate, on the amount of the recognized capital gain. However, in some situations, the IRS only taxes you on what's known as a realized gain. So the realized gain is basically your recognized gain subtracting out any fees or costs that it took for you to be able to sell that investment. Now that might sound a little bit confusing, so let's put it into context and look at an example. So let's start with stocks. In the last video, we mentioned that you can make money investing in stocks in 2 ways, from appreciation and from dividends. So let's talk about appreciation. Let's say, for example, that you bought a share of Netflix for $5 2 years ago. Now it's worth $15 and you sell that stock. However, your brokerage platform charged you a $1 fee to sell that stock. So here's what happens from a tax perspective. So because you bought at $5, your basis, and sold at $15, your capital gain and your recognized gain is $10. However, because you had to pay that $1 fee to sell your stock, your realized gain is $9. So that is the amount that you'll get taxed on. And because you held the stock for more than 1 year, you'll pay capital gains, that preferential lower tax rate, on that $9 gain. So your tax bill would be between 0% and 20% of that $9, depending on which tax bracket you fall into. Now, what would have happened if you only held the stock for 6 months? Your recognized and realized gains remain the same. However, what changes is the tax rate that you have to pay. If you hold that investment for less than a year, you cannot get that preferential capital gains rate. You would have to pay your ordinary income tax rate on that income. So if you held it for less than a year, your tax bill would then be higher as opposed to waiting a full year plus to sell. So how do you keep track and know which stocks you bought and sold during the year, for how much, and how long you held them? At the end of each calendar year, your brokerage platform will give you a Form 1099-B, and this is what it looks like right here. You then use this Form 1099-B to file your taxes. And if you care to know specifically where in your tax return that information is reported, it is reported on a Form 8949, which ultimately flows through to Schedule D of your Form 1040. So what about dividends that you get from stocks? Now, if you hold a dividend paying stock, you really don't have a say as to whether or not you receive that income. If a dividend is issued, you're gonna get that income whether you want it or not. So if you receive dividend income from stocks, that income is gonna be reported on a Form 1099 div. And this is what that looks like. These dividend payments are subject to capital gains rate, so it gets that preferential tax treatment. And that is valid whether or not you chose to reinvest your dividends. Once you receive a dividend, it's gonna be taxed. The Form 1099 div will give you a breakdown as to which dividends qualify as qualified dividends and which ones are not qualified dividends. And the difference between the two is that qualified dividends, and that's typically most stocks that most people are trading, would typically be qualified dividends. Those will qualify for the preferential capital gains rates. Qualified dividends are those paid by US companies and international companies that have special treaties with the US. If the dividends are from a foreign country that doesn't have that treaty, that would be considered a non-qualified dividend, and that will be taxed at your ordinary income tax rate as opposed to your capital gains tax rate. Now let's talk about bonds. There are 3 types of bonds out there. First is the bonds that you buy from a company or corporation. The interest or income from these bonds is generally taxable at both the federal and state and local levels at your ordinary income tax rates. The second type is a US Treasury or government bond. So these bonds, though they're subject to federal taxation, most of the time they do not get taxed at the state and local level. Third is municipal bonds. Now, municipal bonds are bonds that are issued by your local government, so like your county or city. Interest income generated by municipal bonds is generally tax-free on both the state and federal levels, assuming that you live in the state that the bond is issued from. And interest received from bonds, including municipal bonds, even though generally those are not taxable, they're still going to be reported on a Form 1099 int, like as in interest, 1099 INT, or a Form 1099 OID. Now, what about income from the sale of a bond? That income is treated like capital gains, including municipal bonds. So if you sell a municipal bond for more than what you paid for it, you're gonna pay capital gains tax on that. Now, the calculation of the gain on a sale of bonds can get pretty complicated because there are bonds that can be bought at a premium or a discount, meaning more or less than the face value of the bond. So it gets a little tricky there, and we're not gonna get into that in this series. But just know that if you do have a capital gain with the sale of a bond, you will have to pay capital gains tax on that. Taxation of pooled vehicles such as ETFs and mutual funds work in a similar way. Because remember, when you buy a pooled investment like an ETF or mutual fund, you're essentially buying small chunks of the underlying investments. However, with an actively managed mutual fund, like we talked about last time, you have an actual person or team buying and selling and picking and choosing those underlying assets. So that buying and selling within the fund, which is known as turnover in the investment world, has the potential to generate more income for you, has the potential to generate more gains because of how frequently they're selling and buying assets within that fund. And of course, you have no control over what they buy and sell. So if the income is generated, you have no choice but to pay the tax on it. Now let's talk about REITs. Generally, dividends that are paid out by real estate investment trusts are taxed as ordinary income. Sometimes, but not very often, they could be considered qualified dividends, which would qualify for capital gains rates, but that is in a very minute scenario. A portion of the dividends that you get from a REIT could also be considered a return of your capital or return of your basis of your investment into that trust. Therefore, when that happens, you don't get taxed on the total amount of the dividend. You're only taxed on the portion that is considered a true dividend. But whenever you sell that reinvestment, your basis will be reduced, which could result in a higher capital gains tax bill at the time that you sell your investment. We have 2 more videos coming out for you guys in this investment series. In our next video, we'll be talking about the practical ways how to get started. We'll be talking about micro investing, a couple of different platforms. I know some of you guys have asked specifically about specific investment platforms, so we're gonna cover a little bit of those in the next video, as well as other ways that you can get started with investing with low sums of money. So make sure you stick around for that video. So I hope this video was valuable for you guys. Once again, if you have not already, make sure you subscribe and hit that notification bell so that you don't miss when we post new videos. If you have any investing related questions, make sure you leave those in the comments below. As you guys know, we typically get back to every single one of you guys, so drop your questions down below. Thanks so much for spending this time with me, and I'll see you in the next video.